R. Sivakumar, Head of Corporate Strategy at Axis Mutual Fund, is now joining us on this issue and overall view on the way things are right now in the economy. So nice to have you on the show today, Mr. Sivakumar. After a very long time, good to see you. First of all, your thoughts on the way bond market and the money market read this news. Clearly, this is a routine, kind of relationship between the RBI and the government. But the amount of the quantum came in way higher than what the street was estimating. Is that what led to the bond yields actually heading lower? And what is your reading of it?
Absolutely, I think it's very obvious. It's very clear that it's a much larger distribution of dividend than the market expected, almost double pretty much what market expectation was, and that is why you have this positivity. I think the most important question is how much does this help the government meet or exceed its fiscal trajectory, the fiscal consolidation trajectory. So I think that's the crucial question that's on everybody's minds. And obviously, this goes a long way towards plugging any gaps in the government's fiscal math. We'll have to wait for the July final budget to get a sense of what that numbers will look like. But I think it's a very, very positive step. And that's why you've seen some reaction from bond markets. The reality is that bond markets have not run away, which also implies that the markets are going to wait for the final budget before it sort of makes sense to draw a longer term trend from this data.
A quick follow-up, Mr. Sivakumar, last time round, the importance of the interim budget, but the biggest takeaway from that budget was the lower borrowing number, which market really liked a lot. And, without really compromising on the capex front, if the government is able to, curb on the deficit, that is something which people really liked on the street in terms of prudent manner of, running the economy. So this time round, going into the budget, if the same reflection is there, continuity of, do you think this will go down well for the market as an overall economy as well?
Absolutely. I think the government is faced with two choices, right? One is they can use this higher than expected dividend to further consolidate, or use this money and spend it towards capex or other pressing needs for the economy. But either of those choices, and both are good choices, really. Our bond markets will obviously be happier if they use to consolidate the deficit. But I think if they use it for capex and infrastructure, that also makes sense because you are increasing the potential GDP growth for the economy as a whole. And that, again, is not a bad outcome from a bond market perspective, because remember that fiscal math is always seen as a percentage of GDP, and anything you use to raise GDP is about as effective as you use to bring down the fiscal numbers, right? So in terms of the ratios. So I think the market will be waiting for that. Of course, a poorer outcome would be if you use borrowing for revenue expenditure or kind of what's considered poor quality spending. But as long as this is used for capital spend and infrastructure spend, I would think that markets will take it in a more positive light.
Taken, but what's your own expectation going forward, the base case scenario being that this government will actually continue after June 4th as well? Do you expect any shift in their nature of spends? Yes, you talked about how both are good options, but there's this increased clamor that this time around it might result in a bit of slowdown of capex and increase in social subsidies, etc. Is that what you are hearing or you anticipate?
Let's wait for the final numbers. I think the fact is that while bond markets are happy about this transfer, and obviously it will help the fiscal, markets really would want to wait for the final government budget to make a sense of where we are headed over a period of time. Because it's not just the RBI dividend which is underpinning the bond market optimism. As you mentioned, the interim budget already kind of gave a signal of fiscal consolidation. The recent prints on inflation, etc., are all, especially core, gives a lot of hope for markets that we are heading into lower interest rate regime. So overall, we are seeing all the positives. Now, once we get the budget out of the way, I think we will get a clear direction as to where markets are going to go. I would say that from a bond market perspective, if you are investing, if you are choosing to invest in which part of the curve, don't wait for all the risk to be resolved. Because if you're going to wait for all the risk to be resolved, then market yields will not be here. They should be much lower. So I think from an investment perspective, you have to take that call that directionally the government is going to do the right thing in terms of either consolidating the deficit or in terms of choosing the right priorities for spend.
Okay, Mr. Sivakumar, on that note, we'll let you go. Good chatting with you as always, and hope to see you more often on the channel from here on.
If you like this video, then like, share and subscribe to ET Now.